Hello, what's good, guys? Super excited right now. I welcome you all to my YouTube channel. If this is your first time, kindly subscribe to this channel and turn up your post notification bell for you to get notified when I drop an amazing videos like this. So, I welcome you all once again to my YouTube channel. In this video, I'll be taking you through the process of forex trading from the beginners to the advanced level. A lot of my friends have been disturbing me to teach them how I make money from the financial market. But in this video, I'm going to teach you all for free. Just stay tuned and watch out, guys. Welcome back, guys. Here are the basic context I'll be talking about in this video. Firstly, introduction to forex trading, forex major currency, exotic currency pairs, the base and the quote currency, market participants, forex broker, type of forex broker, criteria for selecting a good broker, terminologies in forex trading, forex market analysis, key psychological consideration for a forex trader, and lastly, my mode of view to forex trading and my advice to newbies like you watching this video. Without further delay, let's straight into the video. Firstly, introduction to forex trading. Forex is the simultaneous buying and selling of two currency. It must involve two currency. Forex is the biggest market in the world. It is 200 times bigger than the stock exchange put together market. It is 24/5 market, and it has a liquidity of over $6 trillion daily. It is the change in the exchange rate that allows you to make money from the foreign exchange market. Forex market open from Sunday 10 o'clock p.m. GMT +1 and closes on Friday 10 p.m. GMT. Note: money is traded in the forex markets. Forex major currency pairs. The most commonly traded currency pairs are United States dollar, euro, Great Britain pound sterling, Canadian dollar, Swiss franc, Australian dollar, and the Japanese yen. Forex pairs are in three letters. The first two letters represent the country's name, while the last letter represents the country's currency. We have what is called the IOS, which means the International Standardization Organization. They are the body that formulates the forex major currency units. For example, Euro USD, the Eurozone, and the United States dollar. Another one is USD JPY, which is the United States and the Japanese yen. Another one, GBP USD, United Kingdom and the United States. The first two letters stand for the country name, while the last letter stands for the country currency. For example, the USD, which is the United States, and the dollar. GBP, the Great Britain pound sterling, which is the Great Britain and the pound sterling they spent over there. Exotic currency pairs. Exotic currency pair involves a major currency traded against a currency from a developing or emerging economy, often characterized by low liquidity and high volatility than the major pairs. The pair commissions charged on these pairs are usually very huge because they are not heavily traded. Exotic currency pairs are formed by pairing a major currency like USD, the Great Britain pound sterling, and the Japanese yen with a currency from a developing or emerging economy. For example, USD TRY, which is the United States Turkish lira. Another example is the Euro MXN, the Euro Mexican peso. Another example is the GBP SGD, the Great Britain pound sterling, and the Singapore dollar. USD ZAR, which is the United States South African rands. The AUD and the NOK, which is the Australian dollar and the Norwegian krone. The AUD and the PLN, which is the Australian dollar and the Polish zloty, the Australian dollar and the Swedish krona, and a lot of examples like that. The base and the quote currency. The base currency is the first currency in a currency pair, and the quote currency is the second currency against which the base currency is valued. Forex trading involves trading currencies in pairs like Euro USD, where Euro is the base currency and the United States dollar is the quote currency. When you are trading any currency pair, for example the Euro USD, and you are buying that currency pair, you are literally saying Euro is going to be strong at that particular moment and the USD is going to be weak at that particular moment. And when you are selling, you are literally saying Euro is going to be weak and the United States dollar is going to be strong at that particular moment, which is vice versa. The forex market participants: banks, commercial company, hedge funds, central bank, and individual speculators participate in it and exchange currency on daily basis for both speculative and hedging purposes. Reason for trading the forex market: the first reason is for the profit reason and the non-profit reason. The central bank moves the market dramatically through monetary policy, exchange regime settings, and currency intervention. In rare cases, they trade the market for the sake of control, for them to have the full control of the market. Forex broker: a forex broker is a financial services company that provides a platform for traders to buy and sell foreign currency, the currency pairs, in the foreign exchange market, which is the forex market. Type of forex brokers: we have the dealing desk broker and the non-dealing desk broker. The dealing desk brokers are the brokers that act as a counterparty to their client trades, potentially taking the opposite side of the trade. The non-dealing desk broker are the broker that passes on order to the market participants, ensuring a transparent trading environment. Example of the dealing desk brokers are the Orlando market, the XM, the IG market, FXTM, the Ava market. While the non-dealing desk broker are the IG market, Light Finance, Fortes, the Exness market, and Admiral market, etc. A lot of them like that. Criteria for selecting a good forex broker: in this video I'll be listing 6 different criteria for you to select a good broker. Number 1 is the regulation and the compliance. The second one is the security. The third one, the deposit and the withdrawal. The third one is the trading platform. The fourth one is the execution and the customer service. You have to ensure they are good in all these aspects for you to select a good broker. Terminology in forex trading: 1, we have the pip, we have the spread, we have the leverage, the margin, the equity, and a lot more like that. The pip stands for the points in percentage. Basically, it is the size of the smallest change in the price that your broker accepts, which means we humans, we move in form of steps. While the market moves in form of pips. Another one is the spread. The difference between the price at which you buy a currency, which is the bid price, and the price at which you sell it, and the price at which you sell it, the ask price, is what we call the spread. Another one is the leverage. Leverage allows traders to control large position using a small amount of capital. It allows you to control a large position with your small amount. Another one is the equity. It refers to the total value of a trading account, including the account balance and any unrealized profits or losses from open position. How to calculate your equity? Equity equals to your account balance plus the unrealized profit or loss. The total gave you equity. Another one is the margin. Margin is essentially the amount of money that a trader needs to put forward in order to place a trade and maintain the position. Margin is not a transaction cost but rather a security deposit that the broker holds while a forex trade is open. We also have what is called the margin call. A margin call is a notification from your broker that your account liquidity has fallen below the minimum requirement to maintain open position, prompting you to deposit or fund or close position to restore the required margin. A margin call occurs when the liquidity in your trading account, which includes your deposit capital plus or minus your any profit or losses, drops below the required margin level. That's when you get your margin call. Another one is what we call the chart, a forex chart. A forex chart is a graphic that illustrates the historical price movement in a currency pair over a time. The bid and the ask price. The bid price is the price at which a broker or market maker is willing to buy a currency pair from you. The ask price is the price at which they are willing to sell it to you back. Another term in the forex market is what we call the long term, which means buying a currency pair with the expectation that the price will rise, aiming to profit from the subsequent increase. The long means buy, while we have what we call the short, which is also the sell. A sell position involves selling a currency pair with the expectation that its value will decrease, allowing traders to profit from the price decline. Forex market analysis. Forex analysis is the study of determining whether to buy or sell or wait on trading a currency pair. Currency trading pairs with the exchange rate based on the price of one currency related to the other. Major type of forex analysis include the technical analysis, the fundamental, and the segmental, with any traders using a blend or both approach. There are three types of forex analysis, which is the technical, the fundamental, and the sentimental analysis. Technical analysis. As a quick reminder, technical analysis involves looking at price in a market price issue to try and retry and determine its future move. This type of analysis seeks to find the ideal time and price level at which to enter and exit a trade. Technical analysis is one of the most widely used type of analysis in the forex market because the movement on the chart from the price action can give an indication of how a particular market tends to behave over time, which can make it easier to find patterns and make it easier for you to make money from it. The fundamental analysis involves evaluating the economic calendar, political, and the social factors to understand how they might impact currency value, helping traders to make informed decisions. Another one is the sentimental analysis. The sentimental analysis gauges the collective mood and the emotion of the market participants towards the currency pairs, helping traders to anticipate potential price movement and make informed decisions. By understanding market sentimental, traders can potentially identify potential trading opportunities and make more informed decisions. The key psychology to consider as a forex trader. Trading in financial markets has always been an alluring endeavor. The prospect of financial independence, the allure of fast gain, and the excitement of the markets up and down attracts countless new traders every single day. However, the world of trading is not for the faint of heart. It is a high-stakes game where many are lured by the promise of quick reach but ultimately face harsh realities. One of the harsh realities of trading is the rule of 90, which suggests that 90% of new traders lose 90% of their starting capital within 19 days of their first trade. Conclusively, understanding the rule of 90. The rule of 90 is a grim statistics that serve as a sobering reminder of the difficulties of trading. According to this rule, 90% of novice traders will experience significant losses in their first 90 days of trading, ultimately wiping out 90% of their initial capital. While this rule may seem like an exaggeration or a harsh generalization, it's highly a genuine issue in the world of trading. The steps learning curve and inherit risk, which means as a newbie trader, you have to stick to the knowledge first before chasing the money, because the world of forex is not for the weak. And I wish you all the best of luck. If you make it up to this level, I wish you a very big congratulations, because this is a big level in your life, which is your financial freedom, and I hope you best of luck. I know in this video you drive one or two things in this video. I beg, help me like this video and turn on post notification bell for you to get an amazing videos like this when I drop them once again. Thank you and stay blessed. Bye guys.